What is up, guys? Your agent Tyler Wayrung here, and today we're going to be jumping back into a topic relating to another video I shot here talking all about my investment into Cardone Capital with Grant Cardone. And since I've made that video, I've gotten multiple questions, lots of outreach from journalists, etc., trying to get more information on this lawsuit that Grant Cardone is engaged in relating to his Cardone Capital activities. So since then, I've dug into the lawsuit myself. I'm going to walk you guys through the pieces that I feel are relevant, talk through maybe some things to think through, and at the end I'll give you my honest opinion of how I'm feeling about it, if I would do it again, and my final thoughts on all of the drama surrounding Grant Cardone at the moment. So with that, let's jump in. All right, guys, so as you can see here, this is the court records for Christine Pino versus Grant Cardone and Cardone Capital LLC, last updated June 8th, 2023. What I've done is kind of taken an excerpt of this, and I'm going to walk you guys through what I feel the relevant parts are, because there is a lot of legal jargon in here. And full disclosure, I don't know what half of this stuff means as well, but did a little homework and just want to give you my honest thoughts since a lot of you have been asking. So I'm going to cut through the chase and dig into the parts that I've highlighted that I think just give a good outline of what's going on here and what's kind of in question, and provide my thoughts on it. All right, so nature of the action. And one thing to highlight, this is specifically for Cardone Equity Fund 5, which just so happens to be the fund that I invested in. Again, you can watch that video here where I walk through that whole investment and how that is going. But where essentially the defendants are responsible for false and misleading statements and omitting material facts in connection with public offerings. You also see in here several times statements relating to misleading test the waters communication. And so test the waters is ultimately something that the exercise of really allowing a company to test the market, look, we'll read here, allows companies to test markets themselves to see if there's enough investor interest to make a Regulation A capital raise successfully. So what that's really saying is we're going to allow you to test the waters with some marketing language to see what kind of interest you get before you go through all of the due diligence with putting the fund together and raising money. So if you put some language out there and you don't get any hype around it or no one's interested, then you kind of save yourself all the hassle. But if you do get a ton of hype, it allows you to move that forward. And Regulation A, just for perspective, is for unaccredited investors or those with a net worth of under $1 million or make less than, I believe it's $300,000 or $400,000 a year. And most syndications where you're pulling money together to buy multifamily assets, that's something called Regulation D, and it's specifically for accredited investors, which is why, most normal or everyday investors, as Grant Cardone calls it, can't have access to it because, a lot of people don't have that $1 million net worth or that high enough income to invest in those kind of things. So for Regulation A, I'm just coming back to testing the waters here because you're going to see this multiple times throughout the document. And I'll be honest, I'm a little confused by it because this looks like it specifically gives you access to say whatever you want to gain interest in something and then decide to move forward, which it sounds like exactly what Grant did, but we'll jump back into that here in just a minute. And guys, I'll put the link here if you guys really want to read this through and through, but we'll just want to give you my quick thoughts. So Cardone Capital, Grant Cardone targeted what they call the everyday investor, again, using that terminology, soliciting investors to purchase interest in Fund 6 or 4, however Roman numerals work. These statements are considered test the waters communications, which are considered offers and securities and are subject to anti-fraud provisions and laws. Cardone Capital made a number of false, continuing that out. We'll get into the details here, but in a nutshell, it's everything that he did on Twitter, Instagram, etc., all his social media where he's putting out all these very praiseful, high return statements and posts is where they're coming back to nail him. So you'll see a lot of his posts referenced throughout the video. Here, and I'll skim through a lot of these. Okay, he claimed that investing to 20 would allow investors to earn about $12,000 to $15,000 a year. This statement was materially false and misleading because there was no reasonable basis for this representation, and investors' distributions have in fact been much lower than these amounts. So I highlighted this part because my initial thoughts are, anytime you're getting into one of these investments, you have to go through something, or you can read something called a private placement memorandum or a PPM. And the PPM kind of outlines everything, the whole business plan with this investment. And so when it says there are no reasonable basis, there was a basis, and that was in the PPM, and that was the plan that they had to deliver on these expected outcomes. Now, there's never a guarantee, and there's nothing to say that hey, this business plan adjusted or it changed. So unless there was something in there that was just intentionally false, because everything I read said, yep, here's the plan. We're going to buy this. We're going to raise rents. We're going to do this and that. And here's how we expect to deliver on the returns that we announced. So again, they announced that several times. If you guys are looking at this a different way than I am, drop it in the comments below. But for me, I don't see how they have a ground to stand on with this one here. However, distributions have been much lower than anticipated amounts. Now, that one for me is hard because, like we touched on before, the market can change, things can adjust. So, yeah, I mean, this is not a guaranteed return amount. This is a target, for a reason, because you can never say you can for sure hit that. So, again, that one doesn't really sit right with me. Okay, these statements were false and misleading because Cardone has no reasonable basis for claiming that a given property will triple in value in 5 to 7 years. Again, for me, this one here, if you're familiar with how commercial real estate is valued, you directly control the value based on the income that it generates. So if he has a plan to triple the NOI or the net operating income of these assets, then I think he has a basis for saying that the property value will triple in 5 to 7 years as long as that plan is reasonable and sound. So this isn't like a residential property because you can never say what the market's going to do in 5 to 7 years. It'd be purely speculation. But in commercial real estate, you have a direct input onto what that property will do. So again, that doesn't really hold a lot of water with me. Okay, and then coming back to testing the waters language, in here they say, section 12, whatever, making material misstatements and omissions, offering the documents and testing the waters is prohibited. But when we looked over here, it said the whole point of testing the waters enables companies to test the market themselves to see if there's enough investor interest. So I guess a little conflicting information on test the waters. And I'll be frank, I do not understand this. But when I went out and Googled it and tried to research, it was like the whole intent of this is to test the waters. And if Grant tested the waters with, 12 to 15% IRR and he got interest and moved forward, I don't follow there. But apparently, that section says otherwise. So we'll continue on here. A lot of the same thing here. They just insert a lot of posts. And again, Grant is one of the best salespeople, in the United States. So did he go a little overboard with pushing this? Maybe, but that's who Grant Cardone is. And I take everything he says with a grain of salt because he over amps up everything he talks about. He's a sales guy by nature. So that's what it is. I don't know. I take an extreme ownership outlook on everything I do. So I put myself in that position and say, I shouldn't listen to Grant if he says it's going to 10x. Go read the documents and you decide, put your money where your mouth is. If that's something you want to invest in, I can't see where they have a ground to say, he made a post saying it was going to do 15%. And I thought he was actually serious. And I thought I would have a jet too if I invested in his fund. So for me, that's really not my style. And I just don't align with the way that a lot of this is written here. So we'll continue on. Okay. So this part here, they essentially, Cardone Capital came back and said, hey, we'll go through and we'll audit our stuff. We'll come up with a social media solicitation policy to make sure we get, ongoing future compliance. Basically, whatever. We'll check the box, slap our wrist, and we'll fix it going forward. Somewhere in here, they talk about how, he claimed 15% IRR, but the monthly distributions are very low. But the thing about internal rate of return or IRR is it looks at the total cumulative return and then divides that by the number of years you held the asset. So, we could essentially get zero return for 5 years and then at the end sell for, whatever 5 times 15 is, was that 60, 75? I don't know. But if we get that percent of return and then divide that by all of those years, that's still a 15% IRR. So you can't really judge against IRR until you exit the investment. Yeah, I don't know where it said it in here, but essentially they were trying to say, hey, this has lower than expected monthly distributions to the 15% IRR, because I think distributions have been in the neighborhood of 4 to 5% per year. But however, if we're going to exit this thing and with a very high value, we could still come back and average out 15% over the end. So in my opinion, you can't judge IRR until you exit. And here's a little bit on that. Basically, he was saying if you invested $1 million, you would get $50,000 in yearly dividends, which is a 5% cash on cash. And since 2019, we've had some years of 4, 4, 4, and then we've had 5. We're projecting to be back on 5% this year. So this still holds true based on the actuals that I went back and looked at. Oh yeah, I thought this was funny. They're they're trying to ding him for suspending monthly distributions in April 2020. But if you recall, what happened in April 2020 was a black swan event in COVID, and most asset managers will do the smart thing and preserve capital when things get shaky. And some other investments that I'm in also have done something similar, because you want to protect the asset. You don't want to keep giving distributions out and then run out of cash to manage the property. So in my opinion, this was actually a smart move for him to stop distributions and make sure we got through COVID, and they actually kicked them back in shortly after that. So this one was just kind of comical to me. Anyone in the real estate investment community will know the ongoing debate between an asset and a liability, but we'll read here, Cardone Capital represented that this investment was an asset, not a liability, which was misleading because the interest in the properties acquired were leveraged with financing of debt. So the two ways of looking at this in my mind, and Rich Dad, which is Robert Kiyosaki, says that an asset is something that puts money into your pocket every month or goes up in value, and a liability is something that takes money out of your pocket and goes down in value over time, which in this instance, there's no reference to debt associated or if you're leveraged or not when you bought the property. So in my view of this would still be an asset because it is going up in value and it puts money in your pocket every month in these monthly distributions. But the banker way of looking at an asset versus liability is which column of your net worth or your balance sheet is this going to sit on? And anything with debt sits in the liability side of your balance sheet, but you also have a corresponding asset there that's worth more than that. So in theory, yeah, this one just doesn't hold much weight for me. All right, so let's jump down to the part that actually did piss me off a little bit when I learned about it. But again, let's look at this. So Grant Cardone personally, through his entities, he owns and controls the purchase properties from third party before he sells them to the funds that he's raising money for. So this, for me, is a huge conflict of interest and should have 100% been disclosed to all the investors. But they're essentially saying that Grant already had these properties, and then he's raising money through this fund to sell them from himself to the fund. Right. So, anytime you're selling something to yourself, whose interest are you looking out for in the best there? So, but they're essentially saying he buys the deals, then he sells them to the funds. And I think a little bit lower, he's failed to disclose the acquisition price on all these properties. Huge red flag there. Cardone Capital has also failed to disclose whether the acquired properties at the different acquisition price were paid by the investors in the funds. And then there's also, he goes on to say that he's actually, some of this money that he raised from the investors, he was loaning the money to the investors and then charged interest to the funds. So for me, this is a point of contention, and I do see grounds for him being sued on the basis of the way that this shakes out, if they can prove that. And this section really calls out where they're talking about that they, in the documents, the PPM say they're going to do an independent third-party appraisal of these properties to come up with the value. And essentially, in here, they're saying nowhere did they find grounds that actually happened, and that the market value was really pretty much just put on paper and no one really were to check that out. So, and this section here calls out how he says that we're going to be able to buy these at below market prices, but there's really nothing in here for us to evaluate that. He won't even disclose the price that we did pay for those because we raised funds prior to them actually purchasing the asset. So again, yep, that's another big red flag for me. So you can continue to read here if you want to dig into the details, but those were the material pieces for me that I thought, a lot of those portions, in my opinion, you need to do your own due diligence and research, and you can't just go off of everything that Grant Cardone says. However, if we are, speaking about these normal investors, some of these people just are blue collar, they run their business. They might be, lawn care folks who aren't familiar with IRR and all these different terms thrown around. In my opinion, shouldn't go off a social media post to decide whether or not to invest. However, I think he can do a little bit better about educating and not just selling all the time how good these investments are. Like I touched on before, I take the extreme ownership approach and say, hey, I should have done better. I should have done my own research before making an investment decision myself. Full disclosure here, they gave out lots of, these PPMs and all these documents that you can read if you want. I didn't read any of that. In my opinion, when you're investing in a syndication, you're investing in the sponsor or the syndicator, the person who's actually raising those funds, and you're putting your trust in them that they're going to do the right thing here. So I didn't read this stuff. I just said, oh, $5,000 minimum investment. I'm unaccredited. Let's check this thing out. It was an experiment for me, and I had faith that Grant Cardone was going to deliver because he had to live up to all the hype that he puts out on social media. And I thought, hey, if this thing doesn't deliver, we can call him out and he'll be on blast to, kind of speak up for the lack of returns there. So I thought he was incentivized that way, and that was kind of my thought process about that. So also on the double-edged sword, him being in the limelight here, or the negative light in the courts for these investments and potentially doing some shady business, I think really will hurt him moving forward, because I won't continue to put other funds with him unless he's able to really put out some good information around the selling the assets to himself piece. For me, that's just a big red flag, a huge conflict of interest, and something I would not have jumped into this with if I knew that that was going on behind the scenes. So that's shady business. Grant, if you're doing that, that's pretty shitty of you, and I think you need to speak up and kind of tell us what was happening there and disclose more about behind the scenes what went on. And, based on the outcome of that, we can decide how we move forward and who signs into this class action lawsuit. So yeah, it'll be interesting to see how this thing shakes out, and hope you guys got some value of this. And if you did, as always, a like or subscribe on the channel would be greatly appreciated. That's a free way to support the channel, and share it with someone else. I would be extremely grateful for. I hope you guys got value out of this. But with that, guys, I'm Tyler Wayrung, and we'll catch you next time.